Well, Lou, Beacon came out with a very clever idea, though, last year that is called their market fund, the 3.0 market fund. And when I heard about the introduction, and as I found out the same day, I put 20% of my own portfolio into that fund, came back and from the conference I was attending, put another 20% in. So I dove in headfirst into this fund. I love it, in addition to the rest of my portfolio, which is in the aggressive allocation. What is this market 3.0? Who would want to participate in this? And what's it designed to do? Who's it for? And what's it designed to do? You want to tackle that one?
Sure. Well, historically, Chris Cook, every time he goes into the lab, he comes out with something that's a little bit more improved from what we had before. So when you look at the last 24 years of the equity cycle, we find there's periods where value investing is more successful, and there's periods where growth investing can be more successful or have better short-term results. Our Vantage 2.0 and 3.0 portfolios are highly diversified. Again, all 11 sectors of the economy, equal weighted. Those fall under the category of value. And historically, since 2011, they have done great things for these particular clients that need equity participation, but they want to protect, especially in light of taking income during their retirement. But what about growth? Like 2023 was an interesting year because all indicators said be defensive. Most tactical managers out there were defensive in 2023. But the market was propelled by the magnificent seven large cap stocks that really kept the markets moving in an upward direction. Chris wanted to find out how do we capitalize on that. So he went back in the lab, came out with the Vantage 3.0 market portfolio, where instead of using 11 equal weighted sector ETFs, he built a portfolio that has half in QQQ, which is the NASDAQ 100, your technology stocks, AI stocks, and half of the portfolio in SPY, which is the S&P 500 ticker symbol. So half and half. These are rocket fuel. These things move in bull markets. You wanted to capture the upside, but still have a risk management process in place to turn those off. Again, think light switches. When the markets are doing great, like they are right now, we are fully invested, QQQ, SPY. But should they reach an apex and start to come down away from their normalized trading range, we will turn off those light switches. How will it work? Going back in history, and everything we do is based on math and history, not guts and guesses. We look back at those types of markets. 2022, QQQs were down up to 40% at one point. In 2023, they were up over 54% at one point. So such a volatile portfolio, we want to have the ability to turn that light switch off when it exits its normalized trading range. And that's the science behind 3.0 market portfolio. It's a binary. 2.0 is a binary portfolio where we're either all in or we're all out. Think one light switch, right? We're in all 11 sectors or we're out of all 11 sectors and sitting in treasuries. 3.0, on the other hand, looks at each sector individually and does the risk management at the sector level. On the screen here, we have an example of just healthcare. So what we do with 3.0, since all the sectors are not correlated and some sectors are more volatile than others, some sectors like technology could receive a 10% downdraft quite regularly, where a more conservative portfolio like utilities might only trip out once every couple years. So what we do is we look at each individual sector as its own individual economic unit, and we take a look at 5 different 200-day moving averages to create a normalized trading range that this investment should invest within. And what we do is when the ETF drops below what we call our bear trend line, we sell the portfolio. So over a 200-day period, of course, this channel will go up and down. But in a bear market, the channel will continue to decrease, which will make it pretty easy for the ETF to come back and the price to eclipse the bull trend line, at which point we purchase it again. So 2.0 is all in, all out. Think 3.0 like having 11 light switches, where if, let's say, financials drop, we will sell financials and put them in fixed income, followed by healthcare and industrials and materials. And at some point, we'll be all invested. At some point, we will not be invested at all. And some parts of the year, we might be invested in 6 or 8 of these sectors. So it's a more dynamic type of risk management strategy.
Now, I know there's some listeners here that they turned the switch off in their heads as they were starting to hear some of these things. But if you're attracted at all to the ideas, anything that we're talking about, you can just send an email to info@wealthlegacygroup.com, info@wealthlegacygroup.com, or you can give us a call, 858-569-0633. That number again, 858-569-0633. And we're happy to spend 20 minutes just simply unpacking some of these things together. Whether you choose to hire us or not is immaterial. How can we help you, among other things, plan for a secure retirement? And also hope you'll pick up a copy of our book, Radical Retirement Roadmap, which should be coming out in the next couple months. But to give you more information as well, whether or not you're a client, the goal is just simply to add value to your life, to your portfolio, help you sleep better at night, and also have plenty of money you can spend on grandkids, travel, and a bunch of other fun things.